been a lot of concern that the United States, despite these latest debt deals, might still face a downgrade of its credit ratings. But so far, both Moody's and Fitch have affirmed their top ratings for U.S. debt, while warning that downgrades are still possible. But not a lot of strong conviction in some of these calls. Take a look at how Fitch phrased it. In its report, Fitch just yesterday said, quote, although the debt agreement is a good first step in adjusting the fiscal challenges that the U.S. faces, it is just a first step. Joining me now from London is the author of that report, David Riley. He's a managing director for Sovereign Ratings at Fitch. David, welcome to InBusiness. You still say this trajectory is not one of a country with a AAA credit rating. Are you still saying that a downgrade is on the horizon this August?
Well, I don't think a downgrade is on the cards from Fitch, at least, during the course of August. We are conducting a review of the rating at this moment in light of the agreement that was reached over the weekend and passed into law yesterday. But what we are saying is that while that agreement does take some of the near-term pressure off the US AAA rating, over the medium term, it's still not completely secure. And the reason for that is the agreement that was set out is just an initial first step. It's not going to be the end of the process, and there's still some very tough choices that have to be faced on tax and spending.
Absolutely. That $1.5 trillion that has to be found by this as yet unnamed commission, super committee, I should say. I also want to add in there the new question. There is an assumption within this debt deal that we're going to see economic growth that's going to support tax revenue. We've gotten some weak economic data points right now. Are you starting to worry that the economy could also undercut some of these forecasts?
Yeah, I think you're absolutely right to highlight that as an issue, and it's actually one of the aspects that's actually underpinned, in our view, the US AAA rating. It's actually been not what happens in Washington, but actually the dynamism of the US economy, the fundamental strengths that it has. Underlying productivity growth has generally still held up reasonably well. But you're absolutely right. The recent data has been actually very disappointing. The GDP revisions were especially negative. They suggest the recession was steeper than we thought. The recovery has been even more shallow than we thought. And of course, the forward-looking data is suggesting that the US economy is probably going to drop below 2% growth, which traditionally is the point where it has actually tipped back into recession. So we are seriously concerned about the economic outlook, and that is a material influence on our assessment of the US rating.
So what sort of GDP number would make you more comfortable that the United States would be able to remain a AAA credit rating given the current debt deal?
Well, I mean, what we have in terms of our longer-term projections is an assumption that, first of all, there still is what's described as an output gap in the US, which means that there is potential for some catch-up, some above-trend growth. And we think that the long-term run rate, if you like, of the US economy that we've based our fiscal forecasts on is around about 2.5%. Now, if the data that's coming through, and it's obviously going to take more than 1 month or even 1 quarter's worth of data to prompt us to change that view. But clearly, if the US economy looks like it's going to go into starting to stall, then we might have to reassess both what we think is the size of the output gap, what we think is the medium-term growth outlook. And on that basis, the tax revenues will be that much less.
Yeah, give me a sense as well. You know, we've heard from your agency, Fitch. We've heard from Moody's that at least near term, there's not a knee-jerk credit downgrade. We still have yet to hear from S&P. When we get that downgrade, or we don't, if the consequence is there that we see a downgrade, JP Morgan says it could cost $100 billion a year in terms of raising the borrowing costs for the government. What do you think the impact of a downgrade, even by one of the 3 agencies, would be?
Well, I think, as you've highlighted, I think it would in part depend on whether there's more than one of the agencies. I mean, if there's a split rating, and then investors might take a judgment based on those split ratings. And in addition, I think, as been highlighted by recent developments in the US Treasury market, when times are tough, whether it's in the US or in Europe or globally, money flows into the US Treasury market. We still think that essentially the US Treasury Treasuries are still the safest and most liquid dollar asset, and it's still going to remain very attractive in that respect. So it's very hard, it's very speculative to know what would be the costs to the US government and to the US economy of a downgrade. But presumably over the medium to long term, it would raise the underlying cost of borrowing to some extent.
I want to quickly play some sound for you. Former Treasury Secretary Paul O'Neill was with us yesterday, and he questioned the fact that we've been having this conversation, saying that rating agency calls on sovereigns just shouldn't be regarded in the same way as the downgrades on corporates. Listen to how he said it.
In the next few years, I think it doesn't matter what S&P or Moody's has to say about U.S. Treasury debt, because we have the ability to pay our obligations, admittedly through borrowing, but we still have the ability to do it.
How do you respond?
Well, no, it's absolutely correct. The US, we do think, has a very strong ability to meet its obligations. The judgment that we have to make is whether that's still, if you like, the gilt standard, still the gold standard in terms of the AAA rating. And the reality is that based our track record, based on rating more than 100 sovereign governments worldwide for almost 2 decades, is actually generally pretty good. And I think in that respect, you know, we have value to provide. But at the end of the day, we're analysts, we analyse, we give an opinion. It's actually for investors and policymakers to decide what to do.
All right, David, as you say, downgrading near term still possible. We'll be watching and listening very carefully. Appreciate your time today.